We on? Okay, are we on?
Yes,
Are we
sir.
on?
We can hear you.
Okay, they can hear me. Okay. Thank you very much again. Glad everybody's on and here. We've got 300 people in the building here. They're packed in, Zoom wise maybe. But we've all kind of had to adjust over the last couple of years, but it is good to at least be able to get more information, and Extension's adapted very well. I grew up in Henry County, 4-H. I started when I was 8, before Clover Buds existed. They let me slip in because I had 2 older sisters and my mom was one of the leaders. Now I've been the leader in several clubs. I'm on the 4-H council and extension board. My practice of law is very different in that my undergraduate degree is in animal science. I've got a minor in ag economics, farm management, and a minor, equivalent of a minor in agronomy. But in 1985, it wasn't the best time to go out and start farming. So I always said I didn't want to go to med school because it was, or vet school was just sick animals. So I didn't want to do that. Vet school or med school was sick people. Dental school was bad breath. That's the hierarchy when you don't get into vet school. I thought about I could get a doctorate in reproductive physiology and write a book about bull sperm about 3 inches thick, but who'd buy it? So I'd always, for up until my junior year of high school, the only reason I went to school was to play basketball. But I was about a couple inches too short and a tenth of 2 seconds too slow. So I fit up. Good thing I paid a little bit of attention. So I went to law school. Did that a year, then I realized that I wasn't going to get to do what I wanted really, and I wanted to show cattle. And I was showing registered Charolais cattle mainly. So the dean, he said, well, you can come back, and if I'm here, I'll let you in. But if I'm not here, you got to start over and reapply. Back then, it was about 900 people for every 100 spots. And I kind of waited on that. And he said, but if I waited very long, he'd make me repeat my first year. So I set out 3 years and traveled all over the country showing and selling registered cattle. But really, I was learning from all of these farmers and farm owners, because most of them were in registered cattle were farm boys went away and done good. They were engineers, business people, insurance, lawyers, doctors, but they loved still the farm. So, and the farm managers had animal science or farm management degrees, which is what I had. So I would go and learn a ton from those people, at probably as much as I ever learned in law school. But after 3 years of that, 24 hours in a crew cab truck wasn't as much fun as it was the first time when you're as big as I am. And then also what I really was there, most people thought I was doing cattle, but I was on a nationwide search for the perfect woman. Well, I'd identified her real early, but she's 5 years younger than me, so I had to wait. And my mom used to always say, why do you have to go 200 or 300 miles to go on a date? I said, well, I've got high standards. They may not be walking down the road in Henry County. So 3rd year, we spoke, started dating a little bit. 6 weeks later, we were engaged. She graduated from Ohio State, came down to Henry County, is teaching school. We'll be married 32 years in June and have 2 sons. That grew up showing in 4-H, doing everything with extension. But what I found in coming out of law school was my client, I was running in, I go to the North American and State Fair, and I'd run into my friends from college. And David, he's much older than I am, but he was there about the same time I was, 2 years ahead. So I'd run into those people and they'd have questions. And, so I realized after about 3 years of practice, we can't specialize lawyers in Kentucky. That would be wrong. You can't specialize. Now you can have all these personal injury people on TV, that's advertising. They can't specialize, but we can limit and concentrate. So I limit to agricultural law and I concentrate in farm family. Probably 98% of all my clients are farmers. A lot of them are part-time. A part-time farm in a lot of Kentucky now is 200 or 300 acres. In Henry County, we used to have lots of dairy, over 200 dairies in the 70s when we were growing up. And now we have 5. Owen County, or Shelby County used to have 300, and they now have, I think, 4 or 5. So it's all this has changed, but the one thing that hadn't changed in all my travels all over the country, I learned the same thing that people in Kentucky is you got a lot of good people. And with my clients, I never worry about getting paid. They're always, I can tell you, they're the same kind of people. If you're one of these people, you're probably a potential client. They're active in the church, they're active in their community, they raise some great kids, they've got grandkids, and they want everything for the family. But if they're like my family and every family, I had one guy at my wedding when I was dating, an older guy, said, don't shake your family tree too hard, some nuts will fall off and they'll look just like your family. So you gotta watch that with the family. So a lot of my planning is about the family. So in the series that we're going to do, this is opening up. The series is excellent, and it lays out. If I talked about all of them, it takes 6 or 8 hours, and usually 4 hours has been the limit for most of my audiences. That would be about it. But we're going to go over some general things that we'll cover that will cover the broad picture of the whole series. That Clint's going to do some on, and I'll do some, and the next fall we'll fill in some more. But we'll get our clicker going here, my able assistant. There we go. But for most farm families, whether it's 5 years, 50 years, or 150 years, the farm is different than any other asset. I have financial planners call me all the time. They want my clients, but they don't understand. My clients may have investments, but the most important thing is the land, and the land is not something that's bought and sold and traded every day. It's usually a once in a lifetime event. So with a family farm, how do we keep it? How do we pass it on if we can? If not, how do we preserve the quality of life we want for the children and grandchildren? I've got a 2.5-year-old now. He's about that tall. He's big. And he loves to go to the farm. He lives up in Boone County, but he Zooms on the FaceTimes our goats in our barn when we have our stripping room kidding area. He FaceTimes the goats. So when we're in there, he gets on. He goes, baby goats, and he'll that. And I'll say, Brett, what about this baby? He goes, good goat. So we've got him started. Okay. If in doing any type of planning, Dr. Thrift was my animal breeding professor, and you heard this one a few times. If you fail to plan, you plan to fail. And he kept telling me this, and he always was like, I don't know whether it's just focusing on me or is this, I thought he was. But if you're going to have a plan, a wheel doesn't get it at all. That's just like buying a truck with one tire. But you need a complete estate plan. And if you are trying to pass the farm down, you got to have a business plan. If you're going to have a child or a grandchild come in with you as a partner or even as an employee that may eventually inherit it, you've got to have a business plan. The plan is the body of the plan is your finances. And that's just, is it a will? Is it trust? What's the legal structure of it? That's the body. It's usually driven by finances. That's sometimes the easy part, even though taxes make people's head hurt. But the heart of the plan is health, your health, who's going to take care of you, who are you taking care of? But the soul of all family farm estate planning is the family. Everybody wants to provide for their spouse. Hopefully their kids will get along, and when mom and dad are gone, we hope they have Christmas and Thanksgiving every once in a while together and get along. That's most everybody's goal. And if you don't address those in your planning, you're going to end up with a gap or a hole that's not going to address that important issue. So we're going to go pretty quick here. We got a lot to cover. I'll go fast, and that's why we will have with the input of questions. if we don't get to it tonight, like we said, it's going to flow through, and you'll see when you see this, that we're going to talk a little bit about everything that's going to be in the future in this series. But towards the end, there'll be a lot of wrap up also. So a big question for any family farm, if the finances of the business is the pie big enough? Can we bring in a child, a grandchild as a partner, or even I've had families that lately that they want to give the cattle and equipment to the child, give it to them. And the kid doesn't want it because he can't afford to keep it. Because the way they structured their business, the profitability of what's going on doesn't work, and he doesn't have a good enough off-farm job to do it. But mom and dad have got some other abilities financially to take care of it. So you got to address, is it big enough? Can it provide for a retirement? Can it provide for that younger family and what they want to do? The money, the cash flow is, can you pay taxes? And having income tax, paying income tax is a good thing. If you're paying income tax, you made money. If you don't pay income tax, you didn't make any money. And then what do they talk about all the time in the last 20 years is sustainable agriculture. Well, if it's not profitable, it's not sustainable. I don't care how organic you do it or not. So you've got to look at the money. You got to look at what are cost of administration, that could be appraisals, funeral, burial, grave site, transfer of assets, anything of the expenses that come up in the estate. They take professional input that has cost. Then you always have the non-farm heirs, the children that weren't addicted, that didn't chew on their fingernails or something enough. I've got 3 sisters. They could not find the boundaries of our farm if they had to, if their life depended on it. They don't know the difference between a barbed wire fence and a open wire fence being an interior or boundary, but you've got, but they love the farm. They love the farm, but they don't have the same deal that I have with the farm. And they'll have lots of that with kids. What we're going to hit tonight is going to be inheritance tax, estate tax, gift tax, and income tax. And if you were wanting to get on taxes, we're going to cover a lot of deep stuff real fast, and it won't be a fingernail of what you're going to need to address. And you got to remember that everybody's situation is different, and the answer to all legal questions, if you want to amaze your friends and embarrass your family, whatever question somebody asks you, the answer is, well, it depends. And if you emphasize that well enough, if it depends enough, you might sound like a lawyer and your family will be sort of embarrassed. But every little factor can change everything as far as the question. People, when you drive down the road and you think, well, my farm's just like their farm, maybe. But the real answer is, well, it depends. And it depends on a lot of little stuff. So, okay, we'll go through. Got some good news, got the bad news. The good news is in Kentucky, we haven't changed our inheritance tax law since 1998. But in 1998, we made a big change, and that has stayed the same. So that's been good. You can plan when something's constant, you can plan for it. And the big thing is in Kentucky inheritance tax. Now we have federal estate tax, but in Kentucky inheritance tax, the tax is based on the person that is the beneficiary receiving something, how they are related to the deceased person. And if you would get $500 and you're unrelated, if Dave gave me $500 in his will, I would be subject to estate tax because I'm not related. But we'll get into the exemptions. It applies to the value of the asset at the date of death or shortly after. It's not what you bought it for as far as the tax is concerned, this tax. this tax. It applies to estates. Testate means you have a will. You have a last will and testament. Intestate means you don't have a will. So I've had people say, well, I had a will, I don't have to worry about inheritance tax. That's not true. It's you died. You left something to somebody. Somebody may have to pay inheritance tax. So whether it's with the will, without a will, or it might be in trust, it's still subject to inheritance tax. Now, the good news is in figuring out the tax, go ahead. The Class A beneficiaries, before 98, it was just the surviving spouse was exempt. Now it's the surviving spouse, a child, and that could be by blood or a stepchild or an adopted child. But if you have a stepchild, if they're going to get anything, you have to get it in a will. Under Kentucky law, they won't inherit because they're not a child, they're a stepchild. So if you have a stepchild and you want to give them something, you better make sure you have a will, or they won't get something and it all goes to the not her kids, but my kids. The grandchildren, parents, brothers, sisters, could be whole sisters or wholes or halves. So half siblings can inherit, but they didn't do the stepchildren. So these are all exempt, no tax. Bad news is these people are going to pay tax. The Class B beneficiaries, aunts, uncles, nieces, nephews, son-in-laws, daughters-in-law. So they're going to pay a tax. And the Class C are the unrelated people or an exempt charity or a religious or educational institution. If they're exempt, they don't pay tax. But a non-exempt charity or association or institution would pay tax. So if you left a part of the farm or a farm to the neighbor's kid, he'd be a Class C beneficiary and he'd pay tax. So who you are in relationship to the deceased person determines the tax. All right, if you're a Class B, Class A, remember, is no tax. Class B, the first 1,000 is exempt because that takes care of a lot of people that are maybe just nieces and nephews. They get sprinkled on, but that was 20 some years ago. They get a little more a lot of times now, if they do. But the tax rate, it starts at 4% on the first dollar after 1,000. And then it goes up in a stair-stepping process to 16%. So it maxes out if that Class B niece inherits a $500,000 farm, it ended up being about 16% on the end, and overall it averaged about 12 to 14%. Now, if you left the farm to a niece and her husband, your nephew by marriage, she would be a B, he'd be a C. So sometimes the niece needs to get all the marbles and make her husband really beg for it and not pay the tax as much. Now, Class C, they get a $500 exemption and they still have the same tax rate, but it just doesn't come up quite as it doesn't have quite the exemption, okay? So that's Kentucky inheritance tax. Now we have federal estate tax. So people talk about death taxes. There are two different things, federal, Kentucky, federal. So in the federal estate, any money that goes to a spouse is tax-free, no matter what, no matter how much. Because what they want to do, what they'd love to do is if husband and wife have an estate, say this tall, if it all goes to the survivor, it stacks up. Now the survivor has twice as much in their estate. And there's a greater chance that the government can tax that top end of it. So that's why you get it free. Now, federal estate tax right now affects about 0.2% of the population. So 99.8% of the people that die will never pay estate tax. But if you do, it's serious and it's ugly. And the point I need to go today, or we're going to go today to cover, is to see why some people didn't have estate planning that was done earlier, why they did it, And then what may happen in the future may drive something else. But how the estate tax works in gift tax also affects almost everybody in the form of, do I give it to somebody while I'm alive, or will I wait to give it to them when I've died? And it's important. We'll see examples of that. Okay, so we have our exemption. Anything under the exemption, a lot of people also call it exclusion amount or applicable exclusion amount, but exemption is more the common word. I'll use them a little bit back and forth just so you get accustomed to hearing it. But the tax rates, if you do any planning, you can pass a ton of money without any tax. So the people of that top 0.2%, they can do some planning and pass some huge numbers. So it doesn't apply to a lot, but there's a lot of talk and always is about changing the state tax law. We'll get into that a hair, but that's an all-day conversation. If you've been to any Farm Bureau meetings or cattleman meetings, especially national level, it's an issue. But this is just for historical basis for you for the old, back in the old days. I've been practicing, say, 30 years coming next May. So there were lots of plans done with, 620 years ago, $675,000 didn't take a lot of farmland to get there. I mean, 20 years ago, we were selling farmland in Henry for $3,000 to $5,000 an acre. Some of it is still $3,000 to $5,000 an acre right now. Now, there's other places. I've had clients in Kenton County that I would not bush hog if you held a gun to my head that sold for $15,000 an acre. I always appreciated the boys up here and the girls that drive those bush hogs. They got more guts than I do. But back then, again, 200 acres, you could be up in this tax range real quick, and anything above the exemption was 55% tax. So we were doing a lot of serious planning pre-2000. Then we got up and it went up and up and up. So what I'm getting is some of you may have old plans that are 20 years old. A lot of my clients I've worked with 20, 25 years, and their kids are kind of going, why did mom do that? Why do we do all those trusts and gyrations? Well, that's we're trying to protect the farm. Well, now we're talking about 11. This year it's $12,060,000 per person. So a husband and wife could pass $24,120,000 tax rate. But if you get over that, you're taxed at 40%. So again, this isn't going to apply to a lot of people, but I wanted to explain to you why some of the planning was done not that long ago. This was not long ago to me. I guess I'm getting older now. Right now, I have these question marks. There was a lot of talk this summer. Every farm magazine I know you looked at, because all the ones I get a bunch of them, were addressing doing away with the stepped up basis, making you pay the capital gains tax when the farm transitions, even though it didn't sell. All those things would have destroyed American agriculture as far as the family farm is concerned. So that all got backed off of in the last 2 months. Thank goodness for Senator Manchin. But it's up in the air. But my theory has always been, in the history of the United States, this exemption has never gone down. It's never gone down. And the people in Washington, are they in the $600,000 estate range or the $12 million estate range? Their families are more down in here. I don't think they want to have theirs taxed. So I think it's a discussion or bargaining, but in 2026, it's set to sunset and go back to $6 million. Well, I've got clients across Kentucky that have 1,000 acres that they'd accumulated, inherited, bought, and joined. And we appraised it 5 years ago. It was $7,000 an acre. Bam, there's $7 million. So it will affect us, but we just got to watch it, because with some planning, you can still avoid it. So it's just a trap for the unwary, but also we're talking about that little bitty sliver of people up here. But if you're farming and have very much land and have other assets, if it does drop to 6 million, people will get humped. But the effect of the tax and how gift tax works actually will come into play for everybody almost. The federal gift tax, when you make a gift, you don't pay the tax as the donor. The donee or the receiver of the gift doesn't pay the tax. Well, it's who pays the tax? The estate after you die pay the tax. So what happens this year, it's moved up to $16,000 per person per year, and it doesn't matter how you're related. You can give anybody $16,000 and don't have to file an estate tax return. But if you give anything over 16, you're supposed a state gift tax return. You're supposed to file that gift tax return. Well, a lot of people don't because their estate isn't anywhere near $12 million, but they're giving away the house or the farm, maybe a couple $100,000, maybe $500,000. Well, it's still going to be under the exemption, so it won't matter. So the way it works is if you make a gift, Dave makes me a gift of $76,000, which would be not to me. His son might not like it. But if he makes this gift to me, $16,000 is exempt. $60,000 is not. Well, $60,000 would have to be reported on the gift tax return. And then if he dies this year, that $12,060,000, the $60,000 that wasn't exempt would come off, and his estate exemption would be $12 million. Now, I'm sure he's still getting nervous over there about it, paying tax. But you see, it doesn't affect a lot of people. So a lot of times gifting, you'll see people in the paper gifted a farm or a house. That's how they can do it, is they're underneath these exemption amounts. If you gifted $12 million, $12,060,000 away and died this year, well, if you did all the gift in 1 year, they can look back 3 years and say, well, was this gift in contemplation of death? Was it done to avoid taxes? Well, if you can show that he's been giving it to his grandchild's college fund every year for 5 years and then he died, they're not going to argue about it. But if all of a sudden he gives a whole bunch of money in 1 year after they can get his checking account and see that he paid a lawyer, they're going to go, oh, I think it was in contemplation of death and he brought in professionals. So that's the idea of, you'll hear about a 3-year look back. But if the exemption is 12 million and it is used up, then whatever's left is over zero. So it has a 40% tax. That's the estate tax. Now, let's go. There are lots of ways to do planning. There's each one of these, if it applied to you, it would be a half a day long event. I have a lot of times with clients, so if I was the bigger, any of them, it seems like regularly they're over 60 to 95, and after a couple hours, they're 2 or 3 hours, they're done. Because we look at everything applied in their situation, and they're going to leave. He said, "Where's your restroom?" The wife he said, "I love coming to see you, but my head hurts." And her answer usually is, he had gone 3 hours without the restroom in 20 years. So when you're concentrating on your situation, it's an important thing to you, and you're not worried about the restroom or anything else. And I never have anybody fall asleep in my office because they're going, they've got something they want to fix, and how do I do it? But you can actually now pass $24 million tax-free. So when you hear them talking about estate taxes and people get all tore up about it, well, again, 9.2% aren't going to get affected by it. But there are farmers and ranchers that will get affected by it. And if they do, that family farm's gone. And and there's some other things they were wanting to change. Okay. So if you're into these questions, you need to get help. The big thing for everybody, the number one thing tonight is capital gains tax. That's the name of the game. it used to be estate tax 20 years ago. Now it's capital gains tax. And the reason why we'll work into this though is you have long-term gain and short-term gain. If you bought something and held it less than a year, it's short-term. Some are a little bit longer. Long-term gain, and you have to net short-term gains and losses and long-term gains and losses. But for most of the time, people are dying or selling or gifting a farm that's been in the family more than a few years. So it's the value at the transaction, and we're just going to say 5,000. That's whether it's 1 acre or 2 acres, doesn't matter. But the value of what we're talking about in the land is 5,000, and it was purchased for 1,000, had a gain of 4,000. But the tax basis is what you was paid for this at the time it was purchased. Okay. So we got $4,000, but the tax rate, state and federal combined, is 20% in some cases. We'll get into that. So the tax is $800. Well, okay, I can live with that if you're selling 50 acres. If you're selling 100 acres, well, it's the gain times the rate, it's the tax. And you report that on a schedule on your 10, that attaches to your 1040 that goes with it. We did, my paralegal works with me for 27 years now. We do about 200 tax returns a year. We're some of the only lawyers around Henry County that even look at taxes, but we found so many tax preparers in rural areas had died, or their secretary retired or died, and the lawyers quit doing them. Even the CPAs that are doing them in the rural areas, so many of them don't have Schedule Fs on a 1040. So they don't, when the tobacco buyout went through, that was a major issue. A lot of problems with that, because a lot of people the tax preparers didn't understand that. We don't do what H&R Block does. We mainly do farms, states, trusts, LLCs, a little more complicated stuff, but it's what my clients do. Most of my clients, we don't do the taxes, because if they have somebody doing them, it's just somebody that we can work with. And the accountants always say, well, it's great, you got a lawyer that can speak accounting. And the hard part is, a lot of times lawyers can't speak accounting and accountants can't speak legalese, and it's just a union nightmare. Okay. So, and the capital gains rate in Kentucky is a flat 5%. A couple of years ago, it went from 6%, it got dropped to flat 5 on everything. So it's 5%. The federal estate tax, federal income tax, depends that this is a single person. So if you have zero income up to 3975, you don't pay capital gains tax. So I have a lot of older clients that may not pay tax. But now you got to remember, if they're selling a property, that sale of the asset figures into their income that year. But now if they're gifting one away, that's different, because they're doing away with that asset. If they're selling it, they might still sell it, because this doesn't move much from about 40,000 to a little over almost 350. Or 450,000 is 15%. Most people are falling in this category. Now, if you get over $434,551 a year of taxable income, you pay 20%. But this plus this is your tax rate. And it's due on your regular 1040 when you file that by April 15th. So if you sell the farm in January, you don't pay taxes on it until 12 months, 13, 14, 15 months. So, but it's best to figure out what the tax is going to be, because if you don't put it back, it may not be there to pay the tax. So we usually figure on a more than 20% just in case. Okay. So we got our tax rate, we got that. Now the real difference is for everybody, not just truly wealthy people, but I have clients that have the house, just that little house in town or on the farm. They only own an acre or 2 or 3, but they're wanting to give it away because they heard if they gave it away soon enough and they went in the nursing home, Medicaid couldn't get the money. Well, that's another 2-hour topic for later in the series. Make sure you come back next fall. It's an important one. But the issue here is if you gift it, you got the asset was $5,000. It was gifted, it was $1,000 basis. Well, the gifted asset keeps mom or dad's basis. You know, we're having farms now in Henry County, I know particularly that were purchased by 85 and 90-year-olds for $300 an acre in 1972. Now, 1978, that's a whole other story. It's like $100,000 an acre. But if that farm was then, or let's say the mom and dad inherited that farm, that basis is what it was when they inherited or they bought it. So you got this basis on a gifted asset is the basis that the giver purchased it. So the donor or the giver bought it, whatever they bought it for, that follows the asset to the donee or the recipient of the gift. Okay? So the other side of that is the inherited asset. Well, let's say the value of it is still $5,000 an acre, or what's called $5,000, whether it's acre, whatever, $5,000, but they get a stepped up basis and it's $5,000, there's no gain. There's no capital gains tax. So if I receive my dad gave me a tract of land, and then if I sell it in my lifetime, I'm going to pay capital gains tax based on what he paid for. Now, if I inherit it, it gets this stepped up basis. So that's why a lot of times it's better to inherit the farm than to be given the farm. Now, a lot of times I have clients that say, well, I'll give the farm to my kids. And if one of them wants out and sells it, that capital gains tax is his penalty or her penalty for getting out. But the kid that keeps it will never pay capital gains tax until he sells it or he dies and he gets a stepped up basis. So part of the discussion all summer was they were going after this stepped up basis. They didn't want us to have that. And they were saying in Congress, they were saying that we're going to do away with stepped up basis so that at death, the value would be what dad purchased it for in 1972. And then we'd have a big gain and we'd have a big tax due, but nobody sold the farm. It would be the only tax situation where there's no cash changing hands. All other taxes, generally, there's change in hands. Well, with the exception of, federal, with the exception of your property taxes and car taxes, stuff like that. But income tax wise, there's always cash changing hands that causes the taxable event. But so the stepped up basis is the day to death value of the property. And it either has to be appraised or you could use like a PVA value or the assessed value on a vehicle for your vehicle tax. Or if it's sold within 9 months of the date of death, you can use either one. So a lot of times we want to sell something, we want to get it sold within 9 months from the date of death. Other times it doesn't matter at all because it's going to sell long before then, or it's never going to sell. But we want, if you inherited the property, you want the value of it as high as you can get it because it's going to step up to a higher basis number here. You want a higher basis because if you ever had to sell it, that would make this gain smaller. So hopefully that makes some sense. So next issue is if we have the gifted asset, same asset, it's just he gifted it, signed the deed the day before he died. And on this one, he didn't get that done and the kid inherited it. Up here, there'd be a $4,000 gain subject to the tax of 20%. Or down here, there's no gain. So 0 times anything is 0. So that's why a lot of parents want to hold it until the very last second. But sometimes that's not a wise move either, due to Medicaid and other issues that, again, we'll get into next fall. Now, so that's the main part of taxes that affect estate planning. The estate and gift tax, but the real kicker is capital gains tax. And if what I tell people, if you're over 60 and you're going to buy, sell, trade, or give something away, you better check out the tax implications with somebody that knows, not just the local tax preparer or the local attorney. Get the local attorney that knows, or the local tax preparer that knows, and also can address your own particular situation, because everybody's different according to those brackets, according to how you're related. Makes a difference all the time. I have people say, well, oh, that estate would be simple. And so the wife doesn't do anything. She didn't have to. She's a surviving spouse. Well, then down the road, she goes to selling cattle or equipment. And their tax preparer goes, well, what was the date of death value of your husband's cows? Well, she doesn't know. That was 3 years ago. Well, if she had gone to an attorney to do his estate, they may not have to go to probate court to do a lot of that activity, but they may have got to get a local expert to appraise the cattle, appraise the equipment, because if we get that stepped up basis, now we can sell it. And if it's for that basis or less, we pay no tax. If it's what we paid for it, minus all the depreciation, and it's 0 basis, it's 100% subject to tax. So you got a $10,000 tractor. If you got it appraised and you sold it for $10,000, that's 0 tax. If you didn't get it appraised or have documentation for the IRS, this is for the IRS, this isn't for probate. If you did get the appraisal, then you can go, oh, we got $10,000. If you didn't, you're maybe down fighting the IRS over 0. So 20% of $10,000, that one tractor would be $2,000 of tax. That'd be worth the effort, wouldn't it? And you can get a lot of equipment appraised for $2,000, particularly if you feed the appraisal well and you know who they are. The other issue besides finances is health. If you don't address health in your estate planning, put a blindfold on, spin around, throw a dart at the wall, and see if you want to pick what's the right plan for you. Because again, the important thing is the people. The money is important, but the really important thing is the people. And if you don't take that in consideration, I've had a quality of life question with an older generation, younger generation, was the mom or grandma in this case was in her 80s, and she didn't understand why that granddaughter-in-law wanted to have 3 TVs, a couple of cars, and she, those fancy phones. She didn't realize the TV only cost a couple $100. She thought it was. But that's a whole different perspective. Where that older one, his perspective was the dad there in his 80s said, all this is great, but the most important inventions that went on, he said, back when the teens, when we were kids, we're only barefoot in summer. We're only half naked in the summer. We all got plenty of food, vegetables, meat, and we had plenty of clothes in the winter, and we had fun. We made our own fun. We did a lot of work. But he said, the good old days, I'm not trading them for anything. But the most important thing that happened was toilet paper and air conditioning. He said those grandkids never got up close and personal with a corn cob. So your perspective, an older generation and a younger generation, is a different view on what's going on about what they have. And I know I'm going through that with my boys in their 20s. is reining them back of, it's always time or money. If you haven't got enough money, you better figure out how the time is going to do it. And why didn't we do this earlier? Well, I didn't have the time or the money. Life expectancies. It's not about your age, it's about your mobility and your independence. That's what's important. My brother-in-law, my older sister's brother or husband, he died at 52, 2 years ago. At 50, when he turned 50, we had a birthday party for him, and he was just thrilled to death, and praise God he was even alive. He looked like he was in his late 80s or 90s. Had 2 teeth, blind in one eye, couldn't see out of the other. Literally, he had severe diabetes. He was on dialysis, had horrible problems with his fingers and legs and toes, and no hair, and couldn't heal on anything. But 52. If you saw him, you'd have thought the saddest day was he was in the nursing home. The last 3 years of his life, my sister was in the intensive care unit 280 nights in 3 years with him, a 50 to 52-year-old. He was in the nursing home at Masonic Home, Shelbyville. Across the hall was his brother that was 2 years older. And he just lost his leg above the knee for diabetes. So to them, it's not about age, it's about mobility and independence. And that becomes very important to farmers, is when you can't do those things you want to do in the time you used to do them, or as safely as you used to think about doing something. So life expectancies are critical. If I've got a 60-year-old, I want to know their health history, because I may need to get these documents done tonight because he's got to go to a heart surgery in the morning. But it could be an 80-year-old that doesn't take any medication at all, and his parents live to be 95 each. So that changes your perspectives. That's what I'm saying. Everybody's situation can be a little different from a little fact. Maybe that life expectancy is a grandchild that is going to have care that their parents can't afford, and you're going to have to help out with, or you want to help out. Maybe it's a child. In-home care in the 70s, my great-grandparents, 2 of them, they lived both to be 95. They lived to 93 at the farm. My dad leased the farm, so I was over there every day. Thought it was the greatest place in the universe. I was 8 years old. But I didn't realize that, them being at home was so critical. But she talked to everybody on the phone for 5 miles, and the girls, 70-year-old, would come pick her up and take her to the grocery store. Well, it isn't like that much anymore. You've got people 500 yards down the road that you don't know their name, and you've only seen them when you drive by. It's a different place. The nursing home, up until what we call BC, before COVID, in the BC days, everybody came to see me was, how do I protect the farm from the nursing home? Now it's a 75-year-old crying because his mom can't understand why nobody will come see her in the nursing home anymore. Don't they love her? And he can explain to her about COVID and about everything, and she's okay. Will you be safe? And he'll say, yes, Mom. Next day he calls, and she goes, nobody comes to see me. Don't they love me anymore? And he'll have to go, and he says his brothers and sisters just quit calling because they couldn't handle it. So the issue now is, how do we avoid the nursing home altogether? And that's at a complete another seminar, last one, I think, at the end of the series. Okay. But these are all things you've got to think about for the whole plan. Getting a will ain't going to touch any of these. A lot of these, you see that now. Big thing again is the family relationships. The spouse, you want to take care of your spouse, hopefully, most of the time. You got the in-laws, that's always an issue. I've had several mothers call me and, we need these papers signed by Thursday afternoon. And I'd say, well, why? Well, they're getting married on Saturday. And they don't trust this new little daughter-in-law with being involved in the farm. Well, the children, children are wonderful. wouldn't trade my two, but sometimes we're all not perfect. Now, when they're little, every grandparent says they're all perfect. Now, then the children's spouses, the daughters-in-law, the son-in-laws, these in-laws are mother-in-law and father-in-law. At my wedding, this old guy in Ohio, when I got married, and she said, whatever you do, boys, and keep your mother-in-law happy. If your mother-in-law is happy, you'll be all right. So I've always made it a goal to be the number one son-in-law. And it really worked out when my wife's only sister got divorced. So now I'm always the number one son-in-law. I haven't screwed it up yet. But the children and their spouses, maybe they're not farm kids. Maybe they don't even understand anything we're talking about. Maybe they still love the farm. I don't know. You just don't know. Sometimes they think they're there. I had a cousin that dated a farm girl. She was the ultimate farm child. She milked cows, she baled hay, she cut tobacco, she hung tobacco. They got married, dated for 4 years, 5 years. He graduated college, she graduated high school, got married 18 months later, they divorced. After they got married, she never once walked in the barn again. She was the oldest child of 2 girls, and her dad worked her like a very strong boy or man. The family didn't all blame her for any of that, but it's an issue. The grandchildren, again, having those grandkids being able to come to the house, but are they going to have the opportunities? One of the biggest things we have right now that I see in society that farm kids, we didn't ever have a problem with. I've got a niece and nephew that live on the farm where my mom and dad lived. We bought the farm. My niece and nephew live there with my sister. They're a senior high school and freshman high school. They've never seen anything born, and they've never seen anything die. And that's a whole lot of kids in the United States right now. So they don't have appreciation for life and death like a farm kid does, that's out there pulling a calf or a goat or a pig, or their dog having puppies, or their pet dog gets killed on the road and they see it happen. Those things make your outlook on life very different. So these are things we got to deal with. When your in-laws become outlaws and they call you for that bail money, then the creditors, yours, your kids, or that daughter-in-law that forgot to tell your son about all those debts you had. Divorce, disability, and death, it's a common thing. It seems like there's a whole lot of people I know that are on disability. A whole lot of people I know have been divorced. And all of us are going to die, either tonight or sometime hereafter. And then we have the non-farming heirs. They're wonderful people, but they don't understand. But we want to do something. We want to be fair. We want to be equal. Okay. So that was the estate planning, but we didn't even touch the business plan. And we're probably not going to in this series. That's for next year, right? Is dealing with the operations, disability, divorce, succession, and estate plan. That's a whole bit. If you just got a son coming in or daughter going to be a partner, and that's all, you're just come on in. We used to have a saying in Henry County was when the 90-year-old died and the 70-year-old walked out of the funeral home, this year I get to drive the tobacco setter or the hay baler, the power position. That's succession you got to do. So this business planning is critically important when you're talking about passing on a business asset. Okay. A farm estate plan, you can't just have a will. You can't just have a living will, power of attorney, a healthcare power of attorney for finances. These are all going to come up in the next 2 sessions. So y'all got to tune back in. Same time, different Zoom channel. But when I started 30 years ago, the living will didn't exist. In 94, Kentucky passed the law and it was a half-page long. Living will now that I write is 3 to 4 pages long. Power of attorney for healthcare didn't exist until about 2007 or 8. Power of attorney, when I started, was a half-page long. Power of attorney for finances is 5 to 6 pages. Power of attorney for healthcare is 5 to 6 pages. And then you got a will. Shortest will I've ever written is 3 pages. Longest one was 30 pages. Longest trust ever wrote was 150 pages. You don't know what's going to need, your needs are, you know what you've got, you hope. I have a lot of time getting farmers to exactly nail down how many cows do you have, not how many head of cattle. It's how many breeding cows do you have, how many production units. You know, that's why a lot of times I have to bring in their tax returns, because I can figure a lot of stuff out in the tax returns and asking them questions. But if you need the estate plan, but if you're going to pass the business, you need a business plan too. So, see the old one, it would zip this in and real slick little sound effect. And it really made it neat. Is you got to get it in writing, bend with the wind, because you don't know what's going to happen. If you're not flexible and you don't work with it, you'll get snapped off and torn either like in Western Kentucky. And hopefully y'all help send something through the extension or cattlemen or Farm Bureau or somebody to help out that. It could be us too. And let the other players know what's going on. If you got that kid that is involved in the farming, he needs to know. That'll make his life different as far as he looks at things. So get the complete plan in writing, written plan, get it flexible. Whatever we want to do, we want it flexible because we can say, as the future goes away from us, the spectrum of possibles and probables gets broader and broader. Probables are up close to you. Possibles are way out there. We can't deal with all the possibilities. There's no way we can plan for it. But we can deal with the probables, particularly the ones we know that are probably going to happen. Doesn't guarantee them, but if they do, it'll be a major impact on your plan. So, and communicate with the people. Now, not every family wants their kids to know everything they've got, but they do need to know they have a plan. They do need to know where to find it. And it would be helpful in the kid involved in the business that they know what's going on, that somebody does, because if you can't get it done yourself, it's awful hard to have to go get a guardianship by the probate court. That's 3 to 6 months. And then it's a mess compared to a power of attorney. This is the #1 rule of estate planning, in my opinion. Fair isn't always equal, and equal isn't always fair. It's awfully hard to do that, to be fair and equal. So first thing is you can be fair. That could be an option to purchase the farm that you give one of the kids or several of them, so they don't have to bid against the world at an auction. But then once the farm is appraised and this kid's going to exercise the option to buy it, then they may get their equal half, third, or fourth, depending on how many kids you're dividing it up. So fair isn't always equal and isn't always fair, because there's always one or two of the kids is the one that cleans out your gutters, that changes your toilet paper, it fixes your stopped up sink, and the other kids aren't anywhere around. That doesn't mean they're bad people. It just means one's there and one's not. But if that goes on very long, it weighs on fairness in people's minds. So we have to look into that. What do we do? How do you plan? Again, this had a really cool sound effects. It had screeching tires. It flew in here and went, stop right now. Start doing something. Don't wait for the tax law to get changed. Who knows what's going to happen? Hopefully there's a big snowstorm and nobody go into Washington. Then they can't do anything. That won't be bad. But what if we start with a small part? Figure out, if I'm going to die, 2 doctors say I'm going to die sooner than later, what do I want to do? Who do I want to make a decision, or do I want to make a decision? Who's that going to be? Who's second, third alternate? Get the power of attorney. Get started out. A lot of times we do the little things and then you work through it. You got to eat that elephant one bite at a time. Ask the Georgia Bulldogs. They did it. That was one down at a time. So get some help too, because you don't do this every day. You may have never done it in your life. Now, if you've done the estate for your parent, you got a little experience, but what if your estate's different than theirs? There's little bitty things make all the difference in the world. So get some help. If you've got a farm, get somebody that understands some of those issues. I've seen some good lawyers screw it up because dang it, they didn't have that animal science degree. And they weren't sure what was going on the farm. They didn't understand timeliness or seasonality or values or markets. Current law and regulations, there's always something changing. Medicaid can change regularly. Sometimes it's hard for the poor people at the Medicaid office, at your local office, to keep up with. And it's especially harder for people at church that say, you need to do this. Well, it sounded good, but they don't know the new current regulations changed. Without a plan, you get what comes. With a plan, you may get what you want. So these are the words to think about. So I get out before 11. What time? Nobody fell asleep. Nobody got up, and I got done in an hour. That's pretty good.
It's great.
Did y'all get first shot at questions? Are we still on anywhere
Yes.
else?
Mhm.
Okay.
Yep.
Y'all get first shot at questions since you're here. No questions?
Yeah, on the inheritance tax
Uh-huh.
for grandchildren. What about step grandchildren?
Step grandchildren, that is, I believe, a taxable class B. That's again, that was the children is one thing. No, hold it. The grandchildren steps are good, but great grandchildren are B.
Okay.
A step grandchild is a class A tax free, but you have to have them in your will to get to them.
Okay.
Great grandchildren become B. Y'all got any more?
So they are exempt.
Yeah, grandchildren, step grandchildren are exempt. Now, when you do that, you may have to have some documentation, like birth certificates of that child, who the parents are. Especially when you get different names from the dead person, parents and spouses, things like that, it's easy. Children, usually but you get into nieces, nephews, sometimes you have to document how they're related to the Kentucky Department of Revenue.
Can you repeat that question?
Oh, the question was step grandchildren for Kentucky inheritance tax. The grandchildren, whole, by blood, adopted, or step, are exempt class A's. Great grandchildren are class B's. Do you have a April, or who's got the question? Molly?
April, if you want to talk, if you want to do the questions.
Yeah, so- Yeah, we have one question that's came in chat. And again, I want to tell people, if you've got any questions, go ahead and put them in the chat box and we will address those. The one question we have here is, who do you get to appraise your cattle equipment?
You've got to have some for the IRS and for the revenue cabinet. You've got to have somebody, you definitely don't want to be related. And they have to be somebody that is an expert in the trade or business. Now, usually what I'll use for the cattle or livestock will be either somebody from the stockyards, say it's the owner or the auctioneer that's there at the market every day that's got a letterhead. For registered livestock, horses, I've even had some issues with dogs. The price of dog is unreal sometimes. Good beagles are like quarter horses. They're $3,000, but anything that's not really good is $3 or $50. The quarter horse and the dog. If they're registered, you've got to have somebody that you'd have to have some sort of documentation if the IRS questions you why that person would be able to do the value. Usually be a sales manager, let's say it's cattle, a sales manager for Angus sales or Charolais sales or Hereford sales. Equipment would be a dealership, somebody that does the sales department at a dealership, consignment. We have a really big consignment place in Campbellsburg in Henry County, right off of 71, has 4 huge equipment sales. So I can get them to come over, and they travel around. I've taken them several places in the state. There's different places that have somebody, but it would have to be somebody that's an expert in that trade or business, that if you got questioned by the IRS, they could document why they would be a certified expert. Now, on equipment, you might even go to Machinery Pede or some of these online services. That may help. Just like your NADA, your Blue Book value for trucks and cars. There's a lot of that for equipment now. But it depends on the equipment. It's like everything else. Well, it depends. Because right now you got a lot of equipment dealers in Kentucky that don't sell anything over 60 horsepower. And that's in Henry and Shelby County too. You buy that 250 to 400 horsepower tractor, you got to go somewhere else. Specialty equipment, trailers, certain livestock trailers, horse trailers, things like that. We might be able to go to the manufacturer, the dealer, say it's a Featherlight or a Sundowner or horse trailer or livestock trailer. So it would just depend on the situation, but that's what you have to look for. If the IRS questions it, you want a stack of papers to defend it or why you got it. And if they see a stack of papers, they'll quit asking questions. If they don't see any papers, they might have you. It's like the old milk inspectors. They fly the speck on the wall, been there all summer, but the other things were getting them, but now they call it on the last one. Okay.
Any
April?
other questions, April?
Can you hear me?
Yeah.
Okay. So we had a comment, 190 acres in Carter County, not farming anything. Land is old abandoned strip mine, $3,000 to $5,000 per acre. So it was a comment that was made. And then another question we had was when a spouse.
Is that deemed? The question really would be if is it deemed agricultural in the sense of versus development? If it's strip mine land that hasn't had anything replanted, whether it's timber or even pasture, timber is obviously an agricultural crop that can be appraised and valued. A land that is, that has been harvested several times in the last 50 years may not be of much value, especially the one replanted. But strip mine land particularly, I think you've got to look at how it was handled afterwards for the value and also for whether it's agricultural or not. I mean, that may be an issue to fight with the property valuation administrator in the county. So what was the rest of their question?
He said not ag land. Thank you.
Okay. So what's the question?
I think it was just a comment.
Okay.
But
that
I
would be how it have to be dealt with. Is what is it? What potentially could it be for to value it to the IRS as far as for a gifting or inheritance or sale?
Okay. And Randy, if you want to have another question, you're welcome to come off mute to ask it directly as well. Another question we had here in the chat box was when a spouse passes away, is the surviving spouse subject to capital gains?
Yes. If they die, they have to document the stepped up basis as to what it was purchased for. But what happens there, let's go a little more. Let's say we've got a farm that was 100 acres and mom and dad bought it 35 years ago. Well, he dies. In the deed, it says survivorship, joint interest with right of survivorship. She automatically gets it by death, but she needs to file, I'll see this all the time. Lawyers, they won't let us put on there he died. Or he died on a certain day. But what you're supposed to do is shortly after the date of death is to file what we call an affidavit of descent or inheritance. And what that does is to document who the person that died, where they live, what county, and what real estate. This only applies to real estate, really. Is what real estate did they own? Identify the real estate. Did the wife get it by survivorship deed, by will, or by trust? And then what's the PVA map number? What's the deed book and page number? What's the fiscal address? And what is the fair market value on the date of death? But you could use the PVA value, or you could get it appraised. The main thing is she may sell that property before she dies. 10 years later, if you go back and have to get something appraised, it'll cost you a whole lot more money than it does right now. Because that appraiser can do it on their computer pretty much right now, but you'd have to dig stuff out from back in time. So when somebody dies, the issue there is his half, let's say they bought it for $1,000 an acre, 100 acres, but his half on the date of death was worth $3,000 an acre. Well, so she owns half of it with $1,000 basis and half of it with a $3,000 basis. So when she sells it, and she sells it for $3,000, half of it has no capital gains tax. The half she bought in herself would have capital gains tax because her basis was $1,000 because she bought her half for $1,000. So you see, that's why you need to get it appraised. And she would be subject to capital gains on his half, depending upon what it sells for. More likely to be her half. But that's when somebody dies, you need, again, buy, sell, trade, or give something away or inherit something. You need to go get those valuations looked at. But that's one of the biggest mistakes I did see is, well, so-and-so at church told me I didn't have to do anything. Well, we got to pay this appraiser 4 times what it normally would have cost if you'd done that, because he can go back in time and do an appraisal, but the IRS can get real fuzzy about that too. So if it's timely done, it's easier, it's quicker. And what I tell people is change the car titles, change the truck titles. Even though they say survivorship, do it now while you got the death certificates in your hand. Don't wait 3 or 4 years from now when you trade cars. Now you got to go dig up a death certificate and rip the scar back and the Band-Aid off and the scab off and go through the death all over again. I mean, you never forget them. I don't mean that, but it's just do the paperwork when it needs to be done. And people will tell you you don't need to do it. But that was from an earlier time where they didn't know what they were going to start with. Okay?
There was a second part of that question. Does the capital?
The question there was, she said, do we have to get the deed changed? No, you just file this affidavit of death and descent, and that that ties in the source of title with the old deed. So if you sell it, you're good to go. You don't have to redo the deed. Okay.
Well, she said, does the capital gains only apply to the surviving spouse when she sells it?
Capital gains is only, right now, it's only when it's sold. And the gain would be determined by what the basis was. What is it, the gifted basis or the inherited basis? And that's what we explained in the handout. But it's only if it's sold. So let's say mom's died, dad dies, and leaves it to the son. Gets a stepped up basis to $5,000 an acre. He keeps it his entire life. And then when he dies, it goes to his kid. at a stepped up basis at the time of his death. So if it's not sold, there's no capital gains tax due. But that's what they were trying to talk about doing away with this summer and fall. But if they did away with it, again, it would apply to, there were some exemptions and some certain things, but it would hit a lot of people, a lot of farmers would inherit the farm, but then they got to go borrow money to pay the tax on the gain, even though it wasn't sold. So that's what's been beaten back right now. It's kind of now off the table. And they're waiting because now they're getting into the election year and that'll all, who knows, will change. But it's tax law, as you see, is very tricky. And sometimes the regulations get changed and not just by statute or by a bill that's passed through Congress. It could be just a regulation change. Okay.
Okay. We had another question here. Are hunting leases agricultural?
That's in November, I think. Hunting leases of agricultural land, most land that hunting leases, most people don't want to hunt in a subdivision or a parking lot. So generally, yes, it's agricultural land that's being leased. And if like I had on our farm, my brother-in-law had 20 acres of corn. He thought it was growing corn. The deer thought it was a food plot. It's surrounded with woods and a pond. And we'd see 15 deer at a time up there, but we appreciated the food plot. It would be agricultural, but how the income would be, how that would affect the taxes is if it is if you're going to go deep into it, if it was a lease, if the farm owner was doing a Schedule F and he leased it for hunting purposes only to somebody to hunt. Somebody else is growing a crop or raising cattle, but one other guy gets it just for the rights to hunt. Well, would that go on your Schedule F? That, I think, is the real question he's asking. Is that income, the rent that he receives from the hunting lease, agricultural income on Schedule F? That would be no. That'd be rental property income. Now, the lease to the guy for the cattle grazing or the crops, that would be a Schedule F income. I think that's his question. And the same thing that applies when you're doing, well, we're going to get into whole hunting leases, but if you're going to lease anything, you better go talk to your insurance agent first. Definitely before you sign a lease or lease the farm. You might change your mind. Okay.
All right. That was the last question that we had in our chat box.
They're holding back.
They're holding back. So if you're holding back tonight, that's okay.
Yeah.
Jot down your questions. We'll be back with us. Yes. Yes, actually. So yeah, just hang on to your questions. If you think of some after you jump off tonight, so that's okay. No worries at all. We can address them in the future sessions. So
My question was, could you really see me?
Yes, we could see you. Yes.
That little ball on top of that little cone, you can see me. Do I look better?
I mean, I guess the people in person would have to say.
You know, I don't want to have that, 20 pounds the camera's supposed to put on you. That make me pretty big.
No, everything looked great, and we greatly appreciate you jumping on this evening and doing this presentation. It was really great, a lot of really great information, and I know a lot of folks have already been through some of this and know how much it takes to try to figure all this stuff out, because I know went through it. My husband and I went through a lot of this stuff with his dad, my father-in-law, and it is crazy. It's a lot to it and a lot of things you don't ever think about. And so I'm glad we're able to put together this program, and I'm glad, Keith, that you're able to be a wealth of knowledge for everybody too. And we look forward to your future sessions as well. So
I didn't see anybody fall asleep on the Zoom.
I mean, I can't see anyone's faces. So
I thought you were going to see if you fell asleep on.
well, I didn't fall asleep. I thought it was very interesting. So, and I think I'm pretty sure everybody thinks the same. And we've been getting some comments in the chat box.
Usually they
too.
don't fall asleep because I scare them with death.
Yeah.
Or taxes. Maybe that's even worse, taxes.
Taxes are scary. I have to agree. Totally. Yeah. It's one thing certain that death and taxes are certain, right? All right. Well, again, if anyone does have any questions, jot them down. Bring them up at the next sessions, the upcoming sessions, because it's perfectly fine. We want this to be very fluid, and we know things will come up. Debbie, we did record this. We will get this sent out, the link sent out to folks in case you need to rewatch it, or if you miss some of it, we'll have that available. Philip will have to get the link to me, and we'll get it sent out to everybody. So please be watching your emails for emails from me coming up. If you need a copy of tonight's presentation, Keith did send that to me today, and I did email that out to all the ag agents and hort agents in the District 1 county. So that's anyone Bracken County over to Pike County, down to Pike County, Boyd County, and all the counties in between there. We do have some folks in counties that are not in our District 1. That's okay. Get with me if you want a copy of tonight's presentation. I'm happy to share that information. Ag agents, if you had anybody watching, if you didn't see my message in the chat box, let me know how many folks were in the rooms with you. So that way we get a full total from tonight. I think the most we had on this evening on Zoom was 65 folks. So that's great. Next session will be the week after next. I'll send reminders. We will have Clint Quarles on for that one. And that will be the basics of estate planning. And I know all this kind of stacks on top of each other. So it'll be a good flowing session on into the next time that Keith talks as well. So thank you all again for jumping on. Keith, do you have any last minute things?
That's it. Thanks for having me.
All right. Thank you all again. Thanks everybody for jumping on. We greatly appreciate y'all.